Well, McPherson's has overhauled its business as it embeds a new operating model. Under the new model, the firm is focused on capturing market share for its brands through the right channels. So to discuss this, what's coming up, and the company's happier results, I'm joined in studio by CEO Brett Charlton and CFO Sherwin. Gentlemen, welcome. Thanks so much for joining us.
Thanks for having us.
I'll just start with you, Brett, because this is a business that has been around for a very long time. Mm-hmm. And it has had to adapt over the years. I think 1860, are we talking about?
1860, 165 years, yeah.
Yeah, so what is it like to take on a transformation of a company like that?
Well, for a start, it's hugely exciting. I mean, it's a 165-year-old company. It's done everything from engineering to printing to now health and beauty. And what we're into now is this amazing pivot into the fourth kind of turning of McPherson's into pharmacy channels, grocery channels, and FMCG in health, wellness, and beauty. We've got market-leading brands, and we just looked at the business, and as a management team and board, said we can really do some exciting things with this.
And what ultimately is the goal?
Well, the goal is to kind of create in its current stage right now, we're right in the middle of the pivot. So our goal was to remove costs and really focus our categories and our brands inside pharmacy and grocery and develop an online presence. We've got some magnificent market-leading brands in Manicare, Whispers, Lady Jayne. They're all household names, Dr. Lewin's and Fusion, and in more of the formulated space. And those brands got a great name in Australia, but what we had at the time before the transformation, we had another brand called Multix. And what we had was this situation where we weren't in control of our P&L. High freight costs, international freight costs, resin costs, a whole bunch of different inputs, foreign exchange, really made it difficult for us to manage the business. So as they went up, we had to take money from investing on our high margin health and beauty brands and prop the profit up. So the idea was to narrow the portfolio into exactly the brands that we've got, face them into the channels that have got the strong macro tailwinds. And that's what we've been able to do from a perspective of selling Multix. After we'd sold Multix, we then had a really big empty warehouse, so we had to kind of get out of that warehouse and all the costs that came with that. And that's what this first half of trading has done. We're now purely a health, wellness and beauty business, and sales with a sales and marketing focus.
So that sounds like it's made your job an interesting one.
Very interesting.
Okay, so talk to us about how that transformation was expressed in the most recent result.
Sure. So we'd called out to investors about a $4.5 to $5 million cost saving that we were looking for from the business after we took these fixed costs out, and we were on track to do that, which is really encouraging. We reported 2.7 million of cost savings, so we're well on our way, which is excellent. But also, as Brett said, that structural benefit that we're seeing through the P&L is very obvious, and we're quite pleased with that.
Okay, so when you are talking about the first half, revenues did drop by about 6.7%.
That's right.
Is that a reflection of, the transformation itself as opposed to sales?
No, so that's actually a reflection of some of the performance, or mixed performance, I should say, of some of our brands. Two of our brands performed very, very well, which is pleasing. Two of our brands not so well. The two that didn't perform so well, yes, there's some transformation impact in there, but what we're very pleased about is that the diversification portfolio that we've got in the core brands helped to offset those. So it's a mixed performance, some of it transformation related and some of it just the underlying performance of those brands.
So those brands that are underperforming, what do you do with them going forward?
Well, largely, they're fantastic brands with Dr. Lewin's and Fusion. Dr. Lewin's had some out-of-stock issues, which in a transformation of this scale is not uncommon. And so for us, we've been able to resolve those issues. So we're back to all guns blazing on investing in marketing, and then with our customers in their promotions, using their assets to grow Dr. Lewin's. Fusion has been interesting for us because whilst it's going very well in pharmacy and our major customers, the independent pharmacy channel and the health food channel we've got more work to do on kind of expanding our distribution there. We're very confident that those channels are going to come good. It's just a matter of kind of riding them after the transformation. Mm-hmm.
And when you think about demand, are you in some way immune? I mean, I feel like it's an old terminology, but the sort of lipstick effect that even when people are feeling the sort of pinch from cost of living, they're still going to, I mean, you still need your cotton balls or whatever it is to wipe your face. And you know, as you say, these are sort of household Australian names. How do you anticipate you'll be able to keep sales momentum going even as interest rates rise?
We are sheltered to a large degree because these categories, they're not recession proof and not cost of living proof, but what they are is they're everyday essential items. We're in 4 out of 5 households with our brands. We live to make people's lives a lot more comfortable and give them the confidence they need to go out every day and take on the challenges of the world. And our brands are not really super high in cost. You know, they're relatively small basket size in terms of their cost prices. And so for us, our job is just to make sure we're talking about our functional benefits, and we're talking about the quality of our products, and we're talking about where they're sold. And for us, it's the basics of sales and marketing for us, making sure that it's on shelf and sold in a way that people feel attracted to our brands, because they've got a lot of awareness and a lot of kind of good feelings towards them. They're household names, right, in Australia. These brands have been around for a long time.
This is an interesting one. So you chose not to pay a dividend,
Yes.
but you've embarked on a buyback.
Yes.
Talk to us about how that came about.
Absolutely. So I think in the ordinary course, the board's constantly looking at ways to return capital and manage its capital with shareholders, and that was no exception this half. The interim dividend wasn't appropriate at this point in time. We want to get through the transformation process. We'd like to embed the business, and we've also got a bit of an eye on our retained loss position, so that informed that position. But the board did see an opportunity on that on-market buyback, and there's a few reasons for that. Intrinsically, there's some value there to be given back to shareholders in terms of earnings per share, which is great. But importantly, it sends, we think, a really strong signal to the market about the board's confidence in the strategy.
And how is the balance sheet looking?
Balance sheet's good. Very strong net cash position. 12.6 million in net cash for the half, which is up significantly from 30 June, which is good. No debt. Pretty tight inventory position as well, but it's looking quite good.
Yeah, no debt. Interesting. And you've got some big shareholders on your register. Australian Ethical, Pinnacle, Microequities, Nataxis Investment Managers, all of whom presumably are supportive of this transformation process, this change in strategy?
Yeah, feedback from our investors has been very positive. I think we've done what we said we were going to do, and that was when we said we needed to kind of streamline our portfolio and point it in, we were able to sell Multix, and we've been able to kind of keep a level of confidence in things are moving in the transformation, which is good. It hasn't stalled. We've been pretty much on track. There's been some teething issues in the last half, but broadly we're comfortable where we're going. And they see the opportunity as we do, is that there's a great opportunity for a business here that can grow itself over the next 2 to 3 years and really start to kind of punch above its weight.
So in the next half, what's top of list to achieve?
Yeah, top of list is number 1, continue to settle the route to market, make sure that we've got the right amount of stock in the right parts of the supply chain. But really our focus now is wholly on revenue growth. Like, how do we grow our brands in the top line? Because we've sorted the cost base and we've sorted out the cost issues in the P&L. Now it's all about top line growth, which is better marketing, more investments in A&P, working with our customers with their assets, expanding distribution, all of the things, the basics that help a company like ours, an FMCG company, to grow revenues, to grow the top line.
And what's sort of your goal by the end of, is it too soon to be talking about the end of the second half?
No, I don't think so. I mean, we're squarely focused on extracting the rest of that value that we spoke about out of the business. So the 4.5 to 5, we've done well. We're on track for that, but we really want to make sure that we land that for the second half. So we've got our eyes very squarely on that. And as Brett said, as well as revenue growth, they're the key priorities.
Okay. And look, I feel like given this day and age, I have to ask, are you able to use AI as the next leg in technology to help streamline some of these, challenges that every company that is selling a product faces in terms of inventory and the like?
Yeah, it absolutely helps. It's not the answer, not the total answer. You've got to have a human in the loop, but our entire company is being trained on AI. We work with a company out of the US called Section, and just every person in the company is expected to have AI playing a role in what they do, whether that helps them think, helps them to analyse things, or whether it's agents that are coming in now to kind of reduce cost and speed things up, reduce friction points. It's just a part of the everyday of what you've got to be now. You've got to have it involved in pretty much everything you do.